I'm Alan Kenny, Editorial Director with REIT.com. Welcome to the latest edition of Quick Study with my colleague Brad Case, NAREIT Senior Vice President for Research and Industry Information. Our topic today is going to be the performance of the REIT market in April. Brad, looks like REITs performed pretty well in April, continuation of a trend. What were your general takeaways?
Yeah, April was another strong month for REITs, and yet again a month in which the performance of REITs was not matched by the broader stock market. In fact, if you look at the performance of REITs since the beginning of the year, REIT investors have seen total returns of 11.7% in just the first 4 months of the year, whereas investors in large cap stocks, the S&P 500, have seen returns of less than 2.6%. And investors in small cap stocks have seen losses of actually about 2.8%. So it's been a strong 4 months for REITs. Not the same situation for investors in other stocks, and April was certainly a continuation of that trend.
Okay, so we know that REITs performed well, but give us the why.
Well, I think the reason is that the strength in the macroeconomy has made investors more positive about investing in general. And when you compare the REIT performance with the broad stock market performance, I think you're seeing the effects of what happened last summer. Last May, investors got concerned about increasing interest rates, and for some reason, they took it out on REIT stocks, which is not the normal response of the market to increases in interest rates. Normally, when interest rates go up, it's because the macroeconomy is strengthening. That's certainly the situation that we are in right now. And when the macroeconomy is strengthening, REIT returns typically go up because strength in the macroeconomy means higher occupancy levels, better rent growth, and therefore property values go up and also dividends for REIT investors go up. So what we saw last summer was an odd reaction of the market to news about increasing interest rates. And since then, of course, interest rates have continued to increase, and yet the market has come back into the REIT space. So I think what happened was the market reacted a little bit oddly last summer. And as a result, while the broad market was up more than 30% last year, REIT returns, of course, were only about 2.5%. And I think at the beginning of this year, investors observed that and said, well, am I going to get continued strong returns in the stock market? That doesn't seem that likely. Am I going to be able to look for better returns in the REIT market? That seems more likely. And so I think what we're seeing is REITs have benefited from the strength of the economy more than non-REIT stocks have done.
And what about yields? I mean, are we still seeing strong yields from REITs?
Oh yeah, REIT yields are still quite strong. In fact, for yield-oriented investors, I think maybe there are several segments of the REIT market that they should be particularly considering. In looking at, first of all, mortgage REITs, home mortgage REITs are providing very strong yields, better than 10% still. And I think going forward, there's a lot of discussion as to whether the government-sponsored mortgage enterprises, Freddie Mac and Fannie Mae, have a future in that industry. And if they do not have a future in that industry in terms of buying mortgages from banks, then there's going to have to be a part of the financial market that can hold the mortgages that Freddie Mac and Fannie Mae used to hold. And I think investors will look to home mortgage REITs to fill that. So that's a combination of a very strong current dividend yield with potentially an intriguing growth story going forward. A couple of other sectors, I mean, REIT preferred stocks are actually quite similar to mortgage REITs in that they provide very, very strong current income. In terms of equity REITs, we see a couple of segments, healthcare REITs and freestanding retail REITs in particular, that historically speaking have been among the strongest performing sectors of the REIT market, and yet in the last 12 months have been about the weakest performers. And as a result, very strong dividend yields in those two segments. And freestanding retail REITs have current dividend yields of more than 6%, and healthcare REITs have current dividend yields of more than 5%.
All right, well, thank you so much for the update, Brad.
Sure thing.
And for more on this and other REIT news and analysis, be sure to visit REIT.com.